Hey there, everyone. Welcome to this special edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, normally from a rainy Redmond, Washington, today from a sunny Dubai, UAE. It's Monday, February 26th, and so excited to be coming to you from the Middle East. We're spending the week here speaking at the CMT Dubai event coming up later this week. Should be a lot of fun, a lot of really good speakers from North America, from Europe, from Asia, and everywhere in between. So it should be really cool gathering of the community in this part of the world, and a lot of great expert discussions. I hope to bring back a lot of those perspectives and ideas back with me for the show in the coming weeks. Just want to do a quick market recap today and what we're going to be doing as I'm of course on the road this week. Just doing an abbreviated show, catching up on the markets, looking at some key patterns and key moves. Then we should be back to our normal shows next week. So here we go, looking at the markets and our market recap. As I'm looking at the S&P 500, obviously coming off today here on Monday, still above that 5,000 level, but sort of bringing it down from Friday's close. And if you look, today's session, sort of just this slow and steady grind lower. So sort of a short-term distribution feel to the market. But let's be clear. It's pretty good, right? I mean, the conditions are not that bad. And when I'm looking at the S&P down 0.4%, this is not bad, right? This is not a horrible day. This is actually pretty okay. The Nasdaq Composite down slightly, down about 0.1%. Just below 16K, mid caps and small caps. Mid caps actually slightly down. Small caps actually narrowly in the green. So this is one of those rare days in recent history where small caps have actually outperformed large caps. The VIX essentially flat from yesterday's close. Looking here at interest rates, you can see the yield curve essentially moved higher through the course of the day. So the 10-year yield ended the day right around 4.3%. Long bond yield is about 4.4%. Shorter term 5-year yields here around 4.33, we'll call it. The short end of the curve, this is where the Fed is obviously sort of moving, pulling their levers, as it were, still pretty elevated. So we do have that inverted yield curve that we've been talking about for quite some time. Dollar, not too much of a change from Friday's close. Looking at the commodity space, a little mixed here. The DBC, a broad commodity ETF, was up about 1%. Energy prices actually improved through the course of the day. The USO, which is a crude oil ETF, up about 1.2%. Natural gas prices and gasoline up as well. Now, the precious metals were down. So gold down about 0.25%. Silver down almost 2%. Newmont Mining ended up being one of the worst performers in the S&P 500. So the gold trade's still not working, although not breaking down significantly, just not great. Now, a lot of green on the chart of Bitcoin, and a lot of this came over the weekend, right? This is yesterday's session, but you can see Bitcoin sort of accelerating to the upside, almost to 55K, which is a level it's not seen for quite some time. It's currently up around 0.5% here just after the U.S. equity market close. Ether prices flat for the day. Looking briefly at the 11 S&P sectors, we can see that energy at the top of the list, consumer discretionary number 2. Now, those leading sectors were still up only 0.33%. So let's be clear. Today overall was more of a distribution day. Technology and industrials basically flat from Friday's close. On the downside, you have utilities down 2%. Communication services down 1.5%. Alphabet was a big drag on the XLC today. We'll look at that chart here later in the market recap. And then real estate down just over 1%. So sort of a mixed day, but overall more distribution than accumulation, I guess, for lack of a better term. Let's look at a daily chart of the S&P 500, sort of see how things played out through the course of the day today. Now, when I'm looking at the S&P's daily chart, you sort of had that rally Thursday, sort of a stalling out pattern on Friday, and then today coming off a little bit. And it's sort of interesting how that 3-day pattern has been a gap higher to a new high, or new all-time high, narrowly getting to 5,100. Friday's session actually opened a little bit higher, but closed slightly lower, and today actually coming down a little bit. Now, we're still above that green trend line support, and we've been talking about that trend line as a key level to focus in on, right? As long as we remain above that trend line, not that it's the most perfect trading system I think I've ever come up with, but it does sort of give you a good visual representation of the pace of the move, and that's why I think trend lines can be so helpful. As long as we remain above trend line support, conditions are similar, right? Conditions have not changed a whole lot. When we break down through trend line support, that's when you have to be worried about, okay, maybe something's different. That's That's why mid last week here on Tuesday, Wednesday, sort of felt like things might actually start to break down a lot more significantly. It wasn't to be. It ended up being a short-term whipsaw. We gapped back above there, obviously broke to a new high. But for now, not really getting that follow through as we start this new week. If we would break lower and if we would break below those trendline supports, I think on the chart of the S&P, you want to immediately go to the left and find those key levels to focus in on. 49.50 is the low from last week. The 50-day moving average and the low from late January, I think, could be a key level. That's right around 48.50, 48.60. So if we would see further distribution, I would immediately be keying in on some of those most important levels. If you break that, then we're starting to talk about Fibonacci support, and I might need to update these levels actually, given the fact that we've pushed higher a little bit. I didn't have a chance to do that yet, but I probably bumped this level up a little bit to respect the new high, which would mean this Fibonacci support is probably a little bit higher, probably around 47.20, 47.25, and that's probably where I would be looking for the next level of support. And that does line up pretty well with this consolidation range from mid-December to mid-January. Just look at the momentum. We did a webcast last week on the indicator RSI and thinking about price momentum, what it really represents. I mean, look at how the momentum overall has been quite strong. Really, off of the October low, the RSI broke above 50, hasn't touched that level. And that really speaks to the strength of this move. Now, when the market is that strong, it tells me two things. Number one, respect the trend and respect that uptrend as long as it continues. Number two, be wary of a pullback and be looking for signs of a breakdown. So the RSI breaking below 50, right, sort of suggesting that things are different. That's one of the warning signs I might be looking for. Now, of course, going into today's session, as we distributed just a little bit, it's worth noting as of Friday when I updated my market trend model, bullish across the board. So medium term, long term, short term, all bullish. And that's the same for large caps, mid caps, small caps, the NASDAQ 100. So what I think about this kind of environment, or in this type of environment where we're making new highs and we're not far off of new all-time highs just last week, I generally assume that the market is innocent until proven guilty. So to be clear, as long as this trend continues, as long as my market trend model remains bullish, there's not a lot to worry about. I love to think, though, when the market is going higher, I always have that contrarian thinking in the back of my head, right? So what would I need to see to tell me something's different? And things that I'm seeing right now, breadth conditions, less optimal, I think is one of the key themes that we've been highlighting. I think it's mixed right now. Actually, we'll look at some breadth charts here in a minute, but some of the breadth conditions are actually quite strong. There's a lot of stocks making new 52-week highs today. But also, worth noting that some of the breadth conditions have become less positive, things like the bullish percent indexes. But the trend overall is positive. And let's remember that as long as charts keep making new highs and new lows, I'm never a fan of selling things just because you think they might go down. One of the great benefits of technical analysis is it encourages you to stick with things that are actually working. So as long as the trend is going higher, let's remain with those winning charts and leading names. Wanted to go to the McClellan Oscillator. This is a popular chart because it's so pretty. We got the red and green colors just kind of highlighting when the indicator goes above and below zero. Now, recently it's become very, very choppy. If you look to the left, you'll find that, in recent history at least, the McClellan Oscillator has been really good at helping you identify uptrends and downtrends because it sort of gives a signal and then sort of remains in that range for an extended period of time. That has completely changed here. And in the last 6 to 8 weeks, the indicator has become incredibly noisy. I think this tells you more and more about a market in transition. This is at the very least, a leadership rotation where you're starting to see some changes in different leadership themes. But also tells you that the breadth is not overwhelmingly positive, right? Look at the breadth conditions here in November and December. This is when the McClellan Oscillator is well above zero and remains there for about 2 months. That shows you that the breadth data using the advanced decline line, which is what this is derived from, is quite strong. And then when it breaks below that zero line, that tells you that things are changing, right? And the conditions are evolving. Here we're actually seeing the McClellan Oscillator break above zero and spend not even a week before breaking back down. In some cases, a day or two. Just in the last week, we've seen it revolve up and down, above and below that zero line. As of today's close, it's actually just slightly below the zero line. So overall, I mean, I think it's premature to declare this as a major sell signal, just given the noisiness of this chart in recent history. But I am certainly keeping an eye on this one. And the more days we spend below that zero line, I'll turn this red tomorrow if it remains below zero. But the more days we spend below the zero line, I think the more that validates more of a pullback thesis here going into March, which is arguably one of the weakest of the months in an election year. I want to look at stocks making new 52-week highs and lows. We highlighted this at the end of last week that, one of the things we've noticed is that there have been an incredible number of stocks making new 52-week highs. On Friday's session, it was almost 20% of the S&P, almost 100 stocks out of 500 that made a new 52-week high just on Friday's close. Now, today it's down a little bit, around 71 names. That's 14% of the S&P making a new 52-week high, but that's still 14% of the S&P 500 members that made a new 52-week high on today's session. So what you have to remember is, this chart with more green on this chart, that tells you more stocks are making new 52-week highs. That is a sign for optimism. That's telling you there's more and more strength because leading names are continuing to lead. The bear case for stocks, the correction scenario into March would mean a lot less green on this chart. So stay focused on this one to see if we get that rotation away from what I would say at this point is a quite bullish representation of the market trend in terms of the breadth conditions here. Finally, finishing off a couple other charts, and then we'll look at a couple individual names just to complete our journey today. When I'm looking at the VIX, honestly, not much change from Friday's close, right about 1375 or so. So, the VIX in this green shaded area basically represents a low volatility, slow and steady uptrend, right? When you have a market that's drifting higher, you have a market steadily making gains, new highs, higher lows, a lot of stocks leading, as we saw in the previous chart. In that sort of environment where investors are basically sort of accumulating shares as things go up, volatility remains low. The reason why volatility spikes is because people get nervous. This is why this is called the fear gauge. I like to call it the uncertainty gauge. I think it's a better way of describing what this means. It usually represents confusion or uncertainty. Now, people don't get confused and uncertain in consistent uptrends. It's actually a very confident market when the market's going higher and the VIX remains low. So a VIX spiking above 15 is a warning sign. We got a little bit of that warning sign last week. Didn't really continue. We didn't really get moves above 15. So at this point, I think it's back to that sort of low volatility range. This is one of those key charts to watch when the market's drifting higher, when positions you're holding are kind of working. This is the kind of chart that I keep in the back of my mind just to look to see if there's a change. And again, in the last week or two, I think we're starting to maybe see a bit of a change, but remaining in that green area, at least for today, as of Friday's close and as of Monday's close, tells you volatility remains relatively low. For now, no huge red flag just yet, but keep an eye on this chart. I think this is an important one. Also want to point out, actually different chart list. We're going to look at the chart of Bitcoin because Bitcoin had a pretty decent weekend and actually pushed higher. What's interesting about the chart of Bitcoin, of course, big round numbers, right? And if you look back in history, and this is kind of a noisy chart, I have a lot of lines on here, but you look at the horizontal levels. I've highlighted 20,000, 30,000, 40,000, 50,000. It's uncanny how often these big round numbers end up being meaningful pivot points or levels of interest for Bitcoin. And that's not just a Bitcoin thing. That's actually pretty common with a lot of different asset classes. Think of a stock when it hits 1,000 or 100 or even $10 a share. There's often a bit of a meaningful rotation around that level just because it's such an important, I think, psychological level for investors. Now, here a number of things have happened in the last couple weeks for Bitcoin that I want to talk about. First off, we had this sort of choppy consolidation period here, sort of mid-November to mid-February, really. We highlighted this, what we call a pennant pattern, which is when you have a big run and then this consolidation of lower highs and higher lows. Now, we broke out of that pattern to the upside, but then it stalled out and actually broke back below to the downside. It ended up finding support at that big round number of 40,000 and then rotated back above. Now we've broken above the January peak. We've broken above 50,000, pulled back and tested it, and now, as of today's session, pushing even higher, actually getting above 55,000 for the first time since 2021. Now, if you look about it, what's interesting about that break above 50K is that also gets us above the 61.8% retracement level. And I'm not showing the all-time high in the upper 60,000s back off to the left side of the chart. That was back in 2021. But if you think about it, we've now broken above that last Fibonacci resistance level, going all the way back to the all-time high in Bitcoin. So I think the fact that we broke above, pulled back to retest, and then broke out is a pretty constructive pattern for Bitcoin. Overall, this has been a constructive chart we've been highlighting really since the breakout here back in October. I think we remain pretty optimistic about further upside potential in a chart like this that keeps making higher highs and higher lows. All right, just to wrap up this special edition of the Final Bar, let's look at some individual names on the move. I want to highlight Alphabet. Now, Alphabet is not a horrible chart. Let's start there, okay? When you're looking at this chart, I can show you much worse charts, right? Look at some of the media names or entertainment names and communication services, some of the consumer staple stocks. You'll find these slow and steady declines. This is not that, right? This is not a horrible chart. But it's not a great chart anymore, right? This is a great chart when we're breaking out above resistance, when we're making new highs, when you look to the left and you see a lot of daylight. That's what charts like NVIDIA and AMD still look like today. But something like Alphabet actually gapped lower. Now, after that gap lower at the end of January, we did trade higher for about a week and a half, but now we're actually rotating back lower again. We're actually making a new, low, a new closing low, at least for this swing. We're actually back to the range that we were right at the beginning of the year. We've broken down below the 50-day moving average as of today's close. I think one of the more concerning developments I'm seeing is down here at the momentum, on the momentum side. So look down at the RSI with today's drop, which was down about over 4%. Which is a pretty big move and a pretty big name. You're actually seeing us break below Fibonacci support, breaking below the 40 level on the RSI, right? So in a bullish phase, the RSI tends to find support around that 40 level. And when we break below 40, that tells you, okay, elevated risk of us going a lot lower. We're actually seeing that right now. So when the momentum actually weakens, when the RSI breaks below 40, we're starting to gap below the 50-day moving average. Again, it's not the worst chart I've ever seen, but it's not a great chart anymore. At this point, I'm seeing, at least on the short-term time frame, a pattern of lower highs and lower lows. It's actually a little more, a little weaker than you probably want. The other concerning part of this is I don't have any trend lines drawn, but if you drop trend lines off of the lows, we're either breaking those trend lines or we're really close to doing so. So watch trend line support on some of these longer term charts, because when we break them, just like we talked about with the S&P, you break that trend line, it just tells you to revisit that chart. We're kind of right at that point here with the chart of Alphabet. Let's see, next one I want to talk about is NVIDIA. And again, the chart of NVIDIA is still quite strong, of course. We gapped higher on earnings last week. That was arguably the story in the markets last week. Today, sort of treading lightly, sort of treading water, as it were. If you look after the gap higher on Thursday, Friday, and now Monday's session sort of stalled out a little bit. And I think of course, a chart is bullish if it keeps going higher, right? So higher highs, which is what we achieved yesterday. Do we make a higher low? And so I think if we do pull back at all, you immediately key on that low around 660, we'll call it. That's the swing low from last week, just before that gap higher in earnings. There's a lot of support below current levels with that gap, with that lower end of the range, that swing low. And I think as long as we hold that, this chart is pretty good. And the thing is, that's about 140 points below today's close. So there's a lot of movement to be had below current levels and still be a fairly constructive chart in a leading name that has had such a run like we've seen with NVIDIA. I also want to highlight Applied Materials, which is one of the better names in the S&P today. It was up about 3.25%. This actually did make a new 52-week closing high today. It didn't quite make an intraday high, didn't make it above last week's high, but on a closing basis, we closed above $200, which is a pretty impressive feat. Back to the overbought region. Obviously, we're outperforming here in the last 6 weeks as we've emerged from this pullback to the 50-day moving average, just continuing higher. So charts like this, again, we can argue how they might be overextended. We can argue about how they've already had an incredible run. But overall, as long as the trend keeps going, as long as we keep making higher highs and higher lows, conditions are pretty strong. I do want to point out couple other charts here just to finish things off. AMD, we can see here stalling out. So while Applied Materials, NVIDIA making new 52-week highs, AMD actually has stalled out. We're actually in this range-bound pattern. It reminds me a lot of charts like Meta, charts like AMD, charts like Amazon, something like Netflix, maybe. These names that have actually gapped higher and maybe making a little swing higher, but really not getting to to a dramatic new high just yet. AMD is really flat, right? So you have this move higher, and now we're no longer going up. So we're not going down. It's not a bad chart. But if you look at the recent swing low and the 50-day moving average, that is where I would be setting alert, around 160, 165. We break below those levels. This is a chart that has gone from accumulation to distribution. Not there yet. Overall, still holding up okay. And I think as long as it holds that swing low, this is still a constructive long-term chart. But on the tactical time frame, starting to be a little more choppy, sloppy to the sideways. Last chart we'll hit is Tesla, and it's funny, Tesla was actually the biggest gainer out of the Magnificent Seven today, up almost 4%. Now let's remember, this is actually still trying to fill the gap from earnings in late January. So, Tesla's certainly an outlier. Tesla and Apple look very different than the rest of the Magnificent Seven. We've covered that, I think, pretty closely. But watch for Tesla. It's actually very close to filling that gap. And I think if it does so, if it can get above the 50-day moving average, get above the upper end of that gap, that means a break above 216. We'll call it 220 to clear that level. All of a sudden, this is a fairly constructive chart again. Now, let's keep in mind the longer-term structure is still not particularly strong, right? Draw a trend line off of these highs. We still are not above that. The momentum is still quite negative, right? We're just getting above 50 right now. And overall, the RSI has been in a bearish phase really since the July peak. So a lot still to prove on a chart like Tesla, but it's worth noting that one of the most beaten down stocks in the Magnificent Seven, actually probably looking the strongest on Monday session. That's it for the special market recap here on Monday, the 26th. Wish you all very, very well. Thanks for giving us some flexibility this week as we try to bring you a show every day from Dubai. We'll be having a lot of great conversations and bringing some perspective back to share with you on the final bar very soon. But until then, be well, stay safe, and take care.